In this presentation, we will continue on with the comprehensive partnership problem with the statement of partners' equity. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We have already created the balance sheet and the income statement. We created the balance sheet first because that's kind of the whole story. The balance sheet giving us the whole accounting equation, the assets equal liabilities plus equity. But we kind of truncated or didn't quite finish or give all the detail to the partner's equity. We just noted that the partner's equity is all of these numbers here. And so we need to break that out, of course, between the capital accounts, which is what we'll do now. Part of that story in terms of what this number is the income statement. These numbers, part of those blue numbers, is for the 7,100. Now we're going to tell the rest of the story and break this information out to the individual partners, the individual owners, the individual partners. Okay, so to do that, what we want to do is hide some of these cells because I'd like to see this information as close to our data as possible without this balance sheet and income statement being in the way. To do that, then we're going to hide some cells. So I'm going to hide from G to M. So we'll put our cursor on G to see the drop down, and then we'll just drag over to M. Then let go of those selected items, put your cursor on the selected area, right click and hide. When taking a look at the statement of partners' equity, this can be the most confusing statement because it will be the one that changes when we think about different types of entities, when we think about a sole proprietorship versus a partnership versus a corporation. So we always want to keep in mind what's the same and what differs. When we think about the equity section as a total, it's all the same. If we think about the equity as one owner owning everything, if we had one partner, like a sole proprietor, or one owner of all the stocks of a corporation, it's just the same accounting equation, assets equal liabilities plus equity. We would owe that one person assets minus liabilities, or 105,600 equals equity, all the blue accounts, 105,600. So it's all the same in that sense. The only difference is, of course, we need to track this time, like we do with liabilities, who we owe. And in this case, we owe different partners here. And so we got to track their capital accounts, which is similar to a representation of like the subsidiary ledger of who we owe for the accounts payable. We need to know if we liquidated here, who would get what. So to do that, we're going to just break these out between our three partners, Smith, Jones, and Brown. Smith, Jones, and Brown. Now, to break these out, we're going to assume that we have a profit sharing of 231. We'll discuss more about what that means in a second here. What we're going to start off with is the capital account at the beginning. Remember, we're going to basically be telling a story here, so we're going to have the owner's capital account as of the beginning of the time period as of January 1st. This is a timing statement, meaning for the month ended, meaning it's going from January 1st to January 31st, as opposed to the balance sheet, which is as of a point in time. It's similar to the income statement, which is telling a story. The difference between this statement and the income statement is the story doesn't start from zero. We're not starting from nowhere like the income statement and counting up from zero. Here we're starting at where we were at prior to this. Where were we when we started this process out? Now for this particular statement, because it's the first month of operations, it's zero because this is the first month. But oftentimes these capital accounts is where we start at because these capital accounts represent what has been invested during the time period, which is all what happened here, or what we had prior to this time period. Meaning, if we were in month 2 and this was our capital account on this area, it's unlikely that we put a lot of investments in, hopefully, because the goal is to put an initial investment in, generate revenue, and then give draws out, not to keep putting more investments in. So typically when you look at a capital account on a trial balance, it represents the beginning balance or the ending balance of last time period. It's going to go up, but doesn't go up directly as we enter data throughout the time period. It goes up when we close out the revenue to it, which in essence we're kind of doing here in the statement of partners' equity. So here though, these are all investments that happened this month because it's the first month of operations. So I'm going to go ahead and sum up these zeros here. So we're going to say equals the sum, even though I'm not just going to put a 0 and hard code a 0 in there. We're going to use formulas whenever possible to try to uniform the statement. So we're going to say sum of those items. There we have it. And then we're going to have the investments. So next we're going to have investments. And the investments are going to be what has been input here. So again, if it wasn't the first month of operations, we would have to go through to the capital accounts, the GL. And if this was there at the beginning of the month, then it's the beginning balance. It would be up here. If, however, there was some activity, meaning the owner put the money in during the month, then it would go into the investments here. So we're going to pull that number over. So this is a credit. I don't want the credit here. So instead of equals, we're going to say negative of that number, tab. Same thing here, Jones. We don't want this negative. We want to pull it over as a positive. So instead of equals, we will say negative of that number, tab. Brown, same thing. We're going to say negative of this number, tab. And then we'll just sum these up. So we'll use the same sum function here. We could copy this formula down because it's the relative formula, but we'll do the sum function again because it's exciting to do so. So equals the sum. Double click the sum function and highlight those three numbers and enter. Okay, so that's what we have now. Now we're going to increase it by the normal thing that increases equity, that being net income. So net income is all of these numbers. So now we've kind of found a home, by the way, for this number. We found an individual home for this number, and this number. It's only really draws we haven't found a home for. Now, on the income statement, we already found a home for all these numbers, but we're just going to lump them together as part of our story on the statement of equity to get to total equity, because we want to get this whole story there. So notice the statement of equity is really only adding these to find a home in and of themselves. And then it's just gonna lump in this information. We already told the story here on the income statement. So we'll just put it in there as 7,100. So here we're going to say 7,100. Now the problem is that how do we break that out? Like I can say the total, I can work this backwards and say that the total here, I'm going to make it negative instead of equals this number. That's the net income. So if I looked at the total, whether it be a partnership, whether it be a sole proprietor or a corporation, the total is pretty much the same. We're starting here and then we're increasing with any investments, and then increasing by net income, and then decreasing by draws or dividends, depending corporation, partnership, or corporation. But now I've got to break that out between these three partners. And that will happen in accordance with the profit sharing agreement. So we're just going to make it a little bit more complicated, we won't get into it. There's a ton of different ways we can have the profit sharing agreements. We won't get into all the different types of ways you can distribute or divide up the profits. But that's one of the benefits of a partnership, is there's so much flexibility. You can do a lot with the partnership, which is great because, the partners aren't equal in terms of how much work they put in or how much capital they put in. So you can do a lot of different things with a partnership. You have less flexibility with a corporation. But here, instead of just having a 1/3 calculation, we're going to use the 2-3-1 just to show this kind of formatting of how the profit will be. Obviously, if it was 1/3, 1/3, 1/3, you would have that being your breakout if it was an even breakout. But even then, note that 1/3 doesn't break out into a percentage. So a lot of times when people think of partnership percentages, we think of, why don't we just have it 50-50 if there's two partners? Well, that works if it's 50-50, but if it's 1/3, 1/3, 1/3, then it would be like 33.3333%, 33.333, because it's not even, clearly. So what we need is like a fraction in order to make it more exact. So this is one way to write like a fraction. And all you do to do this is allocating to Smith, Jones, and Brown 2-3-1 to Smith, Jones, and Brown's respectively. So all you do to calculate this, if you see this in a problem or see this in a document, it's 2 + 3 + 1 is 6. And then we just take their portion over the total. So 2/6 is 0.3333. And 3/6 is 50%. 0.5, move the decimal over to 50%. And then 1/6 is 0.1666. So this can represent a ratio format, and that'll be a little bit more exact. So we'll do that same calculation here. I'm going to say this equals the total times 2 over 6 tab. Okay, and that's, it could be rounded here. If I add decimals, home tab numbers, add decimals, it's actually a little bit different, but I'm going to round it here. Then we're going to do the same thing here. We're going to say this equals the 7,100 times 3 over 6, because he got 3 Jones, whoever Jones is, over 6 tab. And then we'll do this one more time. This equals the 7,100 times the 1 over 6. And there we have it. Now if we add those up, because they all add up to 6 over 6, or 1, then if we add these up, it adds up to 7,100. So notice we did that kind of backwards. I have the total here, and then we broke out the total between the partners. Okay, and then we have the draws. We're going to say less draws. Here's our draws. We have 3 draws for each partner. And we're going to indicate it's a subtraction by saying less. So I can't use a formula to really pick up draws. We've got to type it in there. And so this is just, it is what it is. And note the partners do not have to draw out money in accordance with their profit sharing, unless it's said in the agreement somewhere. But typically, the profit sharing will not drive the relationship of the capital account balances themselves, partially because the initial investment and the draws can differ from the profit sharing ratio. So we're just going to, it is what it is. So we're going to say that for Smith equals this number. Now we finally found a home for that last number. For Jones equals this number. And then for Brown, that's tab. I'm looking for equals this number. And there we have it. So 5, 6, 4. That means we found a home for this. We found a home for this. We have found a home for this. That should do it. That should recalculate this whole thing to get to that 105,600 we're looking for. Let's see if it does. If it doesn't, we're probably just off by a sign going the wrong way, like adding something when we should have subtracted it. So then we'll just sum this up. Equals the sum of the 5 to the 4, 5, the 6, the 4, adding up to 1,500. And then we'll have the capital account at the end. Same as the beginning title, except instead of the first, the 31st. So this is the story. We had a beginning point. We had stuff that happened, which put us in a different ending point. Now to do this, the common error, I'll give you the common error and then we'll fix it. Common error equals the sum, this is going to be a problem, see if you can recognize it, of all of these items, and enter. And then that would be the same all the way across, relative. And there we would have it. So we'd sum these up. Now we can check that by just highlighting, it should be the sum of all these blue numbers, or equal what we put on the balance sheet, or be 105,600. And this of course is not 105,600. So if we subtract it and say, what's the difference? So we can say this whole thing should be 105,600. 105,600, 105,600. And we're going to subtract that to what we've got, which is 108 minus 108,600. It's off by 3,000. Now, oftentimes it's because the sign went the wrong way. So if we divide that by 2, we say, that matches this number. That number looks like something funny might have happened there. And that, of course, is less, by the sign less. So we didn't put a negative sign here. We said it with words, less. So I'm just going to delete these formulas here. These are wrong. And what we're going to do this time is subtract this out. And I'll do it starting with the total this time, because the total will give us this number. And we can check it without then going to these numbers. We can look at the total first, and that gives us a check that we can do and then apply it to the rest. So I'm going to do a calculation here, which will be equals this plus, that's the initial initial capital account plus the investment plus net income minus or less draws, and enter. And that'll give us the 105,600. So that matches this, 105,600. So we have to do a bit of a calculation to get that, just like you would in a calculator, this plus this minus this. Now, in terms of a formula, you could make it a little bit more fancy. You could say, and this might be a little, if you have to turn this in somewhere, this could look a little bit more impressive. If you say sum, you have to say sum, but stop here, because this one's a subtraction, and then close it up, minus this number, and enter. So you get the same number. Now these will be the same, relatively the same. So we could copy this backwards. I could autofill it back. This will be this plus this, this plus this plus this minus this, this plus this plus this minus this, this plus this plus this minus this. So we could put our cursor here, autofill, and reverse autofill here. Auto puts it in reverse, drives it backwards, and Dr. Phil does the calculation for the autofill. So there we have it. And so the sum of those minus the last one. Now the last check, of course, is that this plus this plus this equals the 105,600, 105,600. Now let's just take a quick look at the relationship between the financial statements. So these yellow items should give us an indication of the relationship. To do that, we're going to unhide. So we'll put our cursor on E, hold down the left click, go to N, click, and then put our cursor on the selected area, right click, and unhide. Okay, so then all these yellow items are where we should tie out. So obviously assets equal liabilities plus equity, that's the first thing we should check. If that's wrong, then we have problems. And that's why really I like to think about the balance sheet first, because this is the major check. And we can kind of get to this number without doing these two statements. And by doing that, we can get this solid check on this number. Now we have the detail of these numbers, because remember this number we had was just summing up everything here. We didn't find a home individually, but we know the total is that, and that gives us enough to be in balance, to know that we are in balance. Now we have the detail, which is this, this, and this. So we can add these here. These connections between Smith should just be this 41,867 from the partner's equity. This should be the 52,950, and this should be the 10,783. And I'll make these yellow to indicate that these should match the other statement. So these, of course, are coming from there. And this one you could sum up now. Instead of summing up over there, this could equal the sum of these items. So it's the 105, or you can say it equals this item. So in any case, they should tie out, they should match numerically. And now we're matching here. And then, of course, the income statement is telling part of the story, breaking out more of the story, the 7,100, which matches the 7,100 here on the statement of equity. So those are the things that should tie out every time on the financial statements to check if they are looking correct. For more accounting information and accounting courses, visit our website at accountinginstruction.info.